Okay, we're gonna. You can. Yeah, you can. I'm sorry. We're going to call a meeting to order, and I'm going to open for a word of prayer, and then Heavenly Father, we ask your guidance on this meeting and our thoughts and our decisions as we would be pleasing to you and what's best for the people of the state of Georgia. For in Christ's name I pray. Okay, well, today we got one bill, a hearing only, but I want to get the committee's input on it and questions and what they think. It is Representative Monahan, if you'll tell us what you're working from and tell us what this bill's about, and you're on the witness mic too, I think. Okay, how about that? See if that works. Oh, I'm sorry.
Can you hear me now?
I can hear you now.
All right. Well, thank you, Chairman Tarver, members of the committee. Today, I have House Bill 389, which is LC 550016. So this bill has to do with the amount of insurance deductibles that are payable by unit owners. It is a very exciting piece of legislation, and I'm honored to have Mr. Rob Forstner and some folks that are going to give you some really great details about what this bill does in the interoperability of insurance.
I'm going to defer to my colleague Ryan Mackey.
All right, Mr. Mackey. Yes, sir. Just sit right
there
for me.
If you will, tell us who you are, and you want him to explain it, or
if he wants to kind of give a crack at it and give his version of it. If I need to clarify anything for him, I will.
Thank you, Mr. Chairman. Thank you for having us today. Appreciate everybody's time. My name is Ryan Mackey. I own a community association management company here in Atlanta, and with me is Stephen A. Winter, who's one of the attorneys that works with our industry. Together we co-chair the Community Associations Institute's Legislative Action Committee. And so the bill that we've are working with you guys today on is related to the deductibles that are able to be applied if there's a loss in a condominium association. And so the condos are required under the Condominium Act 443107 to provide fire and extended coverage insurance in an amount consistent with the full insurable replacement cost less deductibles of all buildings and structures within the condominium. So by statute, we're required anytime we have a condominium building to provide that coverage for the entire building. Unit owners will then supplement that with an HO6 policy to cover their contents, and we'll have some property coverage as well, some coverage A. Speaking with gentleman who works with State Farm actually will provide a certain proportion of that contents policy to coverage A. So State Farm will do 30%. So if you had $100,000 in contents, you would be given $30,000 in that coverage A. We're seeing more and more condos. I don't know how familiar you are with those. A lot of times we only think of them as high-rise condos, the things that we see here in Atlanta. But architecture doesn't really matter when it comes to condos. We're seeing single-family detached homes that are classified as condos, given the zoning requirements that they've got in certain places. So we're seeing more of these. And as these condominiums get bigger, the deductibles are increasing. So current law in 44394 limits the amount of the deductible that can be applied to the owner to $5,000. So we're seeing, in some cases, $25,000 deductibles, $50,000 deductibles. And if somebody has a loss, we're only able to apply $5,000. So if we had a $25,000 deductible in the master policy, we're only able to recoup $5,000 of that deductible. Now, what does that do to the condo association? Well, it can bankrupt them in some cases. They may have money that's set aside for reserves that they're unable to do because they're having to absorb this loss. If you pile up a couple of those in a year, the association is not financially prepared to do that, then we have special assessments. So the person who's responsible for that loss in the absence of insurance coverage may pay that $5,000, but the remainder of the members of the association are picking up the rest of that tab. And so this is not a new thing for associations insuring property. For example, we have many townhome associations that are not condominiums that provide for the master association policy. And in that case, there is no cap to the deductible. So if there is a $25,000 deductible, that is responsible the person who caused the damage. So what this bill does is it takes away that $5,000 cap. It allows us to have the full deductible responsible of the person who created the damage or who would be responsible in the absence of coverage. What they do in the townhome associations and what they would do in this case is have that HO6 coverage to help cover that deductible. So if they had $30,000 in coverage A under their HO6, they would file a much smaller claim under that HO6, which would then pay the deductible. And that is what this bill will do. And I'd be glad to answer any questions, and Stephen would be glad as well.
What number are you? Hughley.
Thank you, Mr. Chairman. Thank you, Representative Monahan and our guests for bringing this to us. Help me understand by giving me a real-life example of how this works.
Okay. So in the event that we've got a stacked condominium, just any one of the condominiums we have here in Atlanta, and there is a pipe burst or a toilet that overflows and leaks down through the rest of those units. That person where that pipe burst, the association would file a claim under the master policy. It's the primary coverage. They would file a claim. They would have a deductible. Might be $25,000 deductible. We would then go to that unit owner and be able to recoup $5,000 of that $25,000 deductible. So the association would then have to make up, self-insure $20,000 of the deductible to that's not covered by their policy.
Well, what caused the pipe to burst?
It could be anything. I mean, it could be freezing temperatures. It could be whatever happens. It could be it could be any peril that occurs that the association has coverage for.
So it seems like you're assessing liability to the unit owner, right? You say if it's something that they cause, that means it's something that they're liable for.
Or something that just occurs naturally within their unit that they would have coverage for if there was no master association. If it was a single-family detached home and there was a loss, that they would be responsible for.
Go ahead, to somebody else.
But you number 7.
I'm number 3.
Go ahead, Mr.
Yeah.
Lowe.
Tell me this, do you have that high deductible because that's all you can purchase, or do you have that deductible in order to reduce your premium?
In most cases, it's because that's all we can get. And as I mentioned, these rates increase as we build bigger condos, as there's more condos within or insurable product within a certain area. I've seen in my practice in Cobb County where we had a developer who built several townhome communities. We saw those deductibles jump from $5,000 to $25,000 just because there was so much assets that were that were insured in that area.
Do you think it's common for the coverage A on an HO6 to be restricted to losses inside the exterior walls of that unit?
No, sir. What we've seen is that that HO6, and again, in townhome products where there is no cap, that HO6 policy kicks in to cover that deductible.
Okay. Is that the ISO form?
Yeah, if you'll give me a second, I can read off. Excuse me.
Or the
I got it. So the ISO form for the condominium master policy reads: a unit owner may have other insurance coverage covering the same property as this insurance. This coverage is intended to be primary and not to contribute with other such insurance on the master association side. The HO6,
Does it say contribute or coordinate?
it says not to contribute. And the HO6 reads that it's for excess over any other recoverable amounts not under the master policy. And so the deductible wouldn't be recoverable in that case.
yeah. Thank you, Mr. Chairman.
Thank you, Mr. Chairman. You got me on. Thank you, Mr. Chairman. Sort of following up Representative Hughley's question, I'm trying to get my mind around this. Say, first of all, you say you represent an association of condominium unit owners, correct?
So, yes, our industry oversees kind of all of the condominium associations, homeowners associations. Yes, sir.
So, how many condominium units do you represent? The majority? You representing all the unit owners of condominiums in Atlanta, for example? Or how many units does your association represent in condominiums?
Stephen, do you have an idea on that?
Are you the largest condominium association?
So no. So we work with the Community Associations Institute. We have a Georgia chapter. It's a national organization that kind of oversees all of condos. My management company that I have, we manage condos within Georgia, yes, but I would not say that I have the majority of them, no.
Okay, well, I'll hit the pause button on that. Let's get back to the example we're talking about. If I understand you correctly, you could have you call it a stacked building, but it could be 100 condominiums owned in one structure, one building.
Yes, sir.
Everybody bought them all individually, and you got a master policy going all over all of it. And I understand why you might want a $100,000 deductible or higher. You've got a pretty good spread of risk there. But what I understand you to say is you could have a cold, hard wind. All the units are constructed exactly the same. Cold, hard wind blowing on one side of the building, and one unit has the frozen pipe and goes all the way down and does $100,000 worth of deductibles, and if that one unit that gets affected doesn't have insurance that responds, you're gonna go after $10,000 for them because they caused the loss.
So the association's required by the statute to have the insurance coverage, yes. So the deductible for where that damage occurred, yes, we would go to that unit owner. Right now, we'd go to them for $5,000. We'd like to be able to go to them for the entire master association deductible. Go ahead.
May I help supplement some of the information? Good afternoon. My name is Stephen A. Winter. I'm with the law firm of Winter, Capriola, Zenner. Sorry, but I do say Stephen A. Winter because we actually have two lawyers named Stephen Winter. So we go by Stephen A. and Stephen M. So we represent over 900 community associations in the state of Georgia. CAI is a national nonprofit organization which is tasked with educating homeowner associations, directors, homeowners, and vendors who supply services to community associations. It's my understanding there's roughly 11,000 community associations in Georgia, and I forgot the number of actual homes, but it's several million individual units. We're here today on behalf of CAI because CAI, while a national organization, there are chapters in almost every state, and those chapters seek to be involved in the state's activities to make sure that we're up to date with all the laws and the different things. Of course, trying to also protect these people who live in community associations. The Georgia Condominium Act, since its inception, I believe in 1976, has a provision that requires the association to obtain fire and extended coverage on the structure of the condominium. And it's key that I say that because the purpose of that provision is to make sure that all of the owners are protected in the event that there is damage or destruction. Because if we were relying on each and every owner to fund damages to the building, they're just not going to have enough insurance regardless of the size of the building. So the Condominium Act in 76 said that if there is a deductible, that the limit on that deductible back then was $1,000 per unit. That same provision has been modified twice so far because it went from $1,000 to $2,500, and now it's at $5,000. There are some people who say, well, make it 10, make it 15, make it whatever. The problem is in today's economy, right? Global warming, COVID, construction costs escalating tremendously. Community associations are seeing very high double-digit increases in their premiums. And the only way, and what happens when the premium goes from $50,000 a year to $100,000 a year, And these premiums can be a lot higher than that in some of the master condominiums. One of the ways in which they try to afford proper coverage, compliance with the Act, is to change the deductibles. So if you have a covered peril, like wind, and you have covered property, the Master Association's policy is required to cover the structure. Regardless of who owns that portion of the structure, and regardless of who's obligated to maintain that portion of the structure. And so what I explain when I go to homeowners association meetings, we call it the flip and shake rule. You have a condominium, you pick it up and you turn it over and you shake it. Everything that falls out is not part of the structure. Everything else is part of the structure, and the association is required to maintain it because, again, if an owner doesn't have insurance and a building is damaged or destroyed, how else are we going to get coverage? So the statute protects all of the homeowners in the community to make sure that there's adequate coverage. Homeowners are required typically to get an HO6 policy, which covers liability, general liability. It covers deductibles. It covers something called improvements and betterments. So if you have a $50,000 kitchen and then you upgrade it to a $150,000 kitchen, typically the homeowner's HO6 will cover that difference. And then, of course, general liability and different things that a homeowner, and personal property that a homeowner would have. But again, what's happened over the years is it went from 1,000 to 2,500 to 5,000, and those numbers just don't apply today. They just don't. There's just too much coverage that has to be in place to protect all of the homeowners, and it just seems it works better when a homeowner can pay a slightly higher premium on an HO6 policy to get to the deductible rather than the association paying $200,000 more or $50,000 more to actually get the insurance. And it works significantly better. It becomes a source of controversy because homeowners, they don't want to get assessed anything. At the same time, all of the other homeowners in the community, they don't want to have to absorb an extra $200,000 loss that could be covered by insurance. And the only reason why it's large is because the deductibles are so large now, and associations are limited in what they can bill back to a homeowner. So the key is to get rid of a number because numbers traditionally don't work, and having it just modify or match what the association obtains really makes the most sense. I don't know if that was enough information. I'm happy to provide additional information on the statute, but it's really important that the association maintain the insurance, and it's really important that the homeowners are protected. And yes, we're adding a little extra liability as far as the deductible, but it is much better and much cheaper to all of the owners to do it in that way.
Just a couple of follow-up questions. Thank you for that information. So are you telling me now that the way that HO6s respond is that if there's only a $5,000 exposure to their policyholder, the unit owner, they limit their coverage to that? Or
No, when
it's completely in absence of any insurance that responds?
No, when there is a peril and the structure is damaged.
A covered peril.
Covered peril, covered property, right? The structure, any part of the structure. The association is really required to file a claim. And the deductible limit, the deductible amount, and there's always going to be a deductible. Insurance companies require deductibles, and those deductibles continue to go up. And also, not only are they per occurrence, a lot of times they are per occurrence per unit. So it could add up to a lot of money, is the first thing. But the answer is the HO6 policies traditionally have covered that gap of the deductible that an owner was responsible for.
And that was my question. Is it just the gap, or does it go higher than that?
Well, there's two answers. For fire and extended coverage,
For property
the cap is $5,000. For all risk insurance, which is like a pipe, there is no cap, which is really the way it should be for everything. But when there is a fire and there is a large amount of damage and the association has a very large deductible that it now faces, it's only going to be able to collect $5,000 of it back, and then the remaining deductible has to be absorbed by all of the other owners in the condominium.
So I'm just trying to get my mind around it.
Yes.
Now, the situations you're describing, my question is if the I don't know if homeowners HO6s have fire legal liability or not. Let's assume they do, and a unit owner is frying something, walks away, and there's a grease fire, completely their fault. That's the situation where they are the proximate cause of the fire, as opposed to the frozen pipe claim that you gave me, where all the units are constructed the same, and all of a sudden this poor one condominium unit owner didn't have anything to do with that.
Yep.
So under the fire legal liability associated with the HO6, you're going to be made whole, completely whole, for any deductible up to the policy. Well, actually, up to the liability policy limits to that HO6. Are you not?
I listen to everything. I'm not sure I understand the question.
So with the tenant, not the tenant, but the unit owner causes the fire.
Yes.
Frying
Okay.
chicken or
Got
whatever. Causes the fire. The building has got $1 million burn. Your association policy is going to be first responder, but they're going to immediately turn around and subrogate
Yes.
to the HO6.
So a lot of condominium declarations will say that they can't subrogate, and that because the insurance policy for the association is in place to benefit all of the owners, whether it's a high-rise with 200 units or you have a condominium neighborhood that has 6 buildings and 4 of them are connected, right? There's always going to be more than one unit that has a peril of being damaged. And the answer is, if an insurance company wants, you can't assume negligence. So if an association's insurance carrier wants to subrogate, the association's insurance company can theoretically go after the HO6 company. Traditionally, they don't, but they can unless the documents forbid that from happening. But yes, you do look to it. It doesn't matter if there's actual fault or not. The bottom line is wherever what happens is you look at the total amount of damage, and then you look at the different units that have been affected, and you prorate that deductible based on the total amount of damage. So if it's 50,000, 50,000, and 100,000, if you divide it by 4, somebody gets half and the other 2 get a quarter. So that the deductible is going to be prorated, but right now the cap is no more than $5,000. And that's the problem, because most deductibles now are 15, 20, 50, 100.
But you're telling me that the deductibles aren't prorated. You're collecting from the quote at fault unit, or where the cause of loss occurred, where the loss occurred. You're saying that one condominium unit owner is going to be assessed, in this case, $10,000. If we do it $10,000, the adjacent unit owner is not going to be assessed.
Well, the law in Georgia, through the statutes and cases, says in the absence of insurance and in the absence of negligence, the entity or person who's responsible to cover the damage is whoever maintains it. So if I just happen to be the unfortunate recipient of somebody else's damage, I'm still going to have to go to my carrier for the property, my personal property, because it's my personal property. If my carrier says, hey, you weren't negligent, but the gentleman upstairs was, they're going to have to prove that the gentleman upstairs was negligent for them to go after them. But other than that, yes, the answer is we're putting the responsibility of the deductible on not where it started, but where the damage occurred.
We could also think about it, I think, in terms of maybe like an electrical fire or something where there is no negligence occurring, but you still have that fire.
The only time you're looking at the person was negligent, walked away from the skillet, is if somebody says there was negligence. Because of the negligence, we don't think our policy should cover it, and then they could try to subrogate.
Right. One final question, Mr. Chair, if I may. So basically, you're managing risk. This is a financing technique, insurance and deductibles, all about finance. In the banking world, you expect people to have insurance on the collateral that the bank is financing, and the borrower in that case has to provide evidence of the insurance. When they don't, there's forced placement. So is there why don't you use forced placement?
That's a great question, and the answer is most condominium documents, especially those, after 1985-ish, whatever, they typically will say that an association's remedy, if an owner doesn't get insurance, is to put insurance in place and then bill it to the owner because it's the owner's policy. But if the association has to do that, it's going to go broke when it has to pay for everybody else's insurance. So we don't want the associations going out and remedying the situation by buying insurance for the unit because, again, those are coming from the common expense fund, and you don't account for that when you create a budget at the beginning of the year.
But you can't attach that as a lien on that unit.
Well, yes, you can, but I don't know how many of you may live in condominiums or townhomes or communities, but every association has a budget. That's what his company, one of the many things that a management company does is they sit down with the board every year, they look at the expenses, and they create a budget. It's a bottom to up budget, which means you look at all of the responsibilities that the association has, and once you know what those responsibilities are, right, cutting the grass, fixing the roof, whatever they are, and then you add up all of the expenses that it costs to do that, and then you divide it by the number of homes in the community, subject to there's some formulas for different size units and such. But the bottom line is we an association can't prepare in advance to know whether there's going to be no claims or there's going to be 4 claims and 4 deductibles that they have to eat. So then let's assume that there's 4 claims and now there's 4 $50,000 invoices. Who's going to pay for that? If the owners are going to pay for it, that's going to be a $200,000 addition to their budget that they haven't accounted for, and they don't want to pay it. And it's a lot better when we talk about risk assessment. It is better for a homeowner to pay, I think you calculated maybe $160 or whatever it may be on an annual basis to increase the coverage that a homeowner can get to cover that increased deductible is far cheaper and far better for everybody. It also cuts down on the logistics because I will tell you from being a lawyer and being involved every time there's a water claim, it becomes very difficult to explain some of these concepts to the owners. So really what we do from an association perspective is we tell the members, here's a copy of the association's declaration page. Bring this to your insurance broker when you get your HO6 policy, and he or she will tell you what supplemental insurance you need so that there's no gap.
Thank you, Mr. Chairman. I guess I'm not wrapping my mind around the fact that the one unit owner can be held responsible for the entire deductible of the association master policy. And, if we're talking about a 6-unit building, that might not be so much, but you're talking 100 units, 200 units in one building, that policy deductible is going to be huge. And so, insurance is about transferring risk, and that's what we're doing here. You're transferring your risk to the unit owner. And why, in my mind, should that be fair?
We're transferring a risk that is to some degree regulated by the insurance that we go get. The association has to get insurance, right? The question is how much are we going to pay? If you don't want to have deductibles and you don't want to put all of that bigger risk on homeowners, then you have to get an insurance policy that has low deductibles, and then instead of the premium being $20,000, it may be $200,000.
So why are you not sharing this deductible? Why are you putting it all on the unit owner? Because in my mind, you're taking away your responsibility at all and putting it all on the unit owner. And in this environment, in the housing environment that we have now, how can we make that make sense to our constituents?
I mean, I do see where you're coming from, and I understand it, but we're putting it on a unit owner that has the ability to add it to their HO6 policy. And they're told, hey, you should make sure you have the right gap insurance to cover it. Again, if an association that has 6 units has $200,000 of deductibles and it's not covered by any insurance, then 6 people are going to have to make up the $200,000, and it is quite difficult to do that. I mean, there are people who don't pay their regular assessments quite frequently. It's a big problem. We try to do the best we can, but there are many people who don't pay. So if we now are going to obtain insurance and put it on their account, instead of them not paying the 3 years of assessments that they haven't paid, they're now not going to have paid 3 years of assessments and a $5,000 deductible.
And
Just to be quick, Mr. Chairman. I assume the heart of the bill starts on line 29 and 30, and if I read that correctly, it says that member's going to be responsible for any amount of money. He might not know what that is initially, and your deductible can change, but he's going to be responsible for the total amount of that deductible, and there's no longer any cap on it.
And as I mentioned before, this is not anything new. This is exactly how the townhome associations work, where we're providing that insurance. So we as a management company will provide to these unit owners, this is the deductible. The deductible was $10,000 in 2023. In 2024, it's going to be $20,000. And what we were able to find in looking into this is, as a couple examples, to move from, say, $20,000 in coverage to $50,000 in coverage, that cost to the unit owner was approximately $150 per year. So they were able to pick up that coverage. So if there was a $50,000 loss in a townhome association, they had that coverage. Their HO6 is covering that, ma'am. So for your question, we're not going to them and saying, I need $50,000 from you, unit owner. I'm not asking you to cover that. We're advising them to get the HO6 coverage that kicks in, where they file a claim under their HO6, which will pay that master association deductible.
Let me just follow up real quick. Would you think it might be a fair statement to say that in the Homeowner Association Act, when the association was required to purchase the coverage for any losses there, it might have been the intent to make the association responsible for those losses?
I don't.
Well, you're saying that the association should be responsible.
I'm saying in the Act.
In the Act,
When they required you to purchase the insurance, do you
Right.
think their intent when they did that was to have you be responsible for those losses?
I think the intent.
no, the intent of the Act is not that the association is responsible for the loss. It's that the association is responsible to get adequate insurance so that all of the owners are protected. Remember, if there's no insurance on a building and there's a fire and 20 units get damaged or destroyed and there's no insurance, that's going to be a big problem. And remember who makes up the association? The owners. So the question is do you want 100 owners to make up a $50,000 deductible, or do you want one owner to go out and spend $150 a year to add that
I
coverage?
understand it. One last, very quickly.
Sure.
In other words, if you've got $100,000 deductible and you have the owner that you want to pay that deductible and he doesn't have any coverage, he doesn't have any money, you now have $100,000 uninsured loss. Is that right?
Correct. And as it exists right now, it'd be a $95,000 loss.
Since the presenter has left us, and I needed to be the same place they were, but we're going to finish up this hearing. Just from a layman's standpoint, as we have COVID and all those things you mentioned, the way this is written, right now we could say it's going to be a $50,000 deductible, and in 6 months we had 4 or 5 more COVIDs, and God forbid we do, it could be a $100,000 deductible, and all of a sudden those homeowners aren't paying. I'm not saying they shouldn't have part of the risk, but all of a sudden it's not $150 premium anymore. It gets up to $10,000 premium.
But
So this needs to be looked at a whole lot deeper than what we're doing, and we're having a hearing only just to see how these people feel about it. But is that not fair to say, with the way this is written, if the deductibles might go to $100,000 in a year, and I'm being facetious, but
Yes, sir.
$200,000 in another year, and if you're just expecting that homeowner who's got into this association 10 years back to foot that, all of a sudden. I don't know the answer, but all of a sudden they got a member of a condo that nobody can afford to keep, and what they've got there all of a sudden becomes worthless. And you're telling us it's headed that way anyway because of other reasons.
And what I would say to that is that yes, they could go obtain coverage, and maybe to move from $20,000 to $50,000 costs $120 per year, and then maybe they need to move from 50 to 100. Maybe that costs them $500 a year. Well, that is still cheaper than the association eating that entire deductible and their assessments increasing. So they're going to pay for it one way or the other. They're either going to pay for it through getting an HO6 policy that covers it, or when the association has to have those losses, the association's got to come up with that money. They're going to have to special assess. They're going to have to increase assessments. They're going to have to do something. So it's going to have to come from somewhere. They don't have an endless supply of money. They're going to either have to not be able to fund their reserves, not be able to maintain the property, but they've got to make up that money somehow. So for us, it seems like the easier prospect is to have that be able to let the unit owner obtain the HO6 policy at a much cheaper rate, and then if they have a loss, be able to have that HO6 policy kick in.
I appreciate the concept that there could be a change in risk allocation, but at the end of the day, as Mr. Mackey said, the owners are paying anyway, whether they pay through a slightly higher deductible or they get a special assessment from the association for $25,000, and then you have 100 very unhappy homeowners because they can't afford a special assessment of that magnitude.
All of a sudden, we're not in a hurry anymore, so we'll stay here till dark. Or
But let me say one thing: it's not.
Let's just.
Sure. Yes.
Did you get taken care of the DOT thing? What we're supposed to?
Yeah, we just let it might be gravelly to the DOT.
Okay, that's good. Excuse me. Now you finish, sir, and we got some more questions.
Yes, you may be able to look at it as a transfer of risk, but it is a strategic and significantly smarter way to take care of the risk, because we're taking risk that could be very high. Remember, in townhome communities, we can do this already, and in other communities, you can do it already, and even in condominiums, you can do it for a water loss.
Yeah.
So we're talking about a little bit more of a limited situation, but at the end of the day, it's a very smart and strategic way to allocate the risk at a much, much lower rate.
Just from a layman's terms, each unit owner could have insurance with a different company.
Or their HO6?
HO6,
Yes,
yes.
You're talking about subjugation nightmare when we start trying to blame who really caused that problem that cost somebody $2 or $3 million. And Chairman Williamson.
Thank you, Mr. Chairman. Just again, a follow-up question. I understand all about risk and transfer and the techniques. I can't get my mind quite around, you're saying where the damage occurred. So, for example, one of these high-rise units, the 4-year-old stops up the toilet, flushes the toilet, parents in their other room doing something, they don't know it, but it floods the apartment beneath it. You're saying that the condominium unit beneath it, where all the damage occurs there, and maybe 2 units on down, you're saying that the unit below is the one that this would apply to, because that's where the damage occurred.
Yes, where the damage occurs is the unit that would be allocated all or a portion of the deductible. If there's a $50,000 loss, and if there's a $50,000 loss, and let's assume that half of the damage is to a unit and half of the damage is to the association's common elements, swimming pool area, whatever.
I just want a yes or no. The kid stops up the toilet. The parents are ultimately responsible for the children. The water goes through and it damages the unit below. You're really not talking to where the parents of the 4-year-old. You're talking to the unit owner in the bottom, where the sheetrock and everything else is just completely ruined, and you're ripping out and doing mold mitigation and all that. Is that correct or not?
I'll say that's correct. You're transferring the unit where the damage occurs is where the deductible gets allocated.
So,
That's true.
okay.
But that's already under the Condo Act.
But then again, if this HO, because none of it really works unless you have an HO6. So you go back, the State Farm's writing where the damage occurred, Allstate's writing with a HO6 right above it. State Farm's going to subrogate against Allstate and get the money back. But I'll shut up.
Well, if certain things run downhill, but the insurance is going right back up there where that kid flushed that commode. It's not going to be the one below.
Mr. Chairman, thank you. I'm interested. You keep throwing around this $120 a year. How do you come up with this rate of what it's going to cost the unit owner?
Yeah, we've just had agents that we work with run hypothetical on customers that they had and said, okay, they had $20,000 in coverage here. What would that cost if we were to write them a policy to move that to $50,000?
So you do realize it's going to be different for each person.
It is.
It's not going to be just a standard $120.
Yeah, absolutely. And we used 150 because I saw some as low as $75. I saw some at $120. That was just kind of an average number a high average number that we found.
Mr. Chair, I got one last thing, and it's just a comment. I'd like to them respond to it if they want to. It seems to me that you might be all right with this proposition if every one of your association members were sophisticated and understood about the insurance and HO6s, but unfortunately that's not the case. So what's going to happen if we were to pass this bill is you're going to have folks out there that you're going to look to for that deductible, and they're not going to have an HO6, and they're probably not going to have a whole lot of money. And so what's going to happen to them if we pass a bill like this?
Well, I can tell you, like I said, this occurs in townhomes that are not condominiums. It occurs every day, and so companies like mine will communicate. You're right; it is a sophisticated and complicated process. And so what we do is, on an annual basis, communicate what the HO6 is, that you need to get this coverage, that you're going to be able to file a claim at a much lower cost because your deductible is $10,000 or $50,000 or whatever it is, so they know what they need to get. And so we keep communicating that information. Go ahead, Steve.
The Condominium Act actually you raise a good point, but the Condominium Act, the reason why the Condominium Act was adopted was to make sure that we can put in writing and put owners on notice of what their obligations are. That's what a declaration of condominium does. When a homeowner buys a house, they're assuming all the obligations that go with that property and that house. We're doing that with respect to the condominium unit owner, but it's on a much more limited basis. And the condominium documents specifically address these issues. So they should be familiar with their association documents because they're buying in a condominium development. We are talking about it as a sophisticated issue. Management companies, associations, lawyers, we all try to make it really easy for people to understand. They just have to get an HO6. And I don't know of any mortgage company that actually doesn't allow a closing to take place without an HO6 in place. So there's always going to be. Now, it's possible that one lapses, but, and that's why if the association has to obtain insurance. But again, if we rely on associations to go get insurance for their homeowners who don't have it, their assessments are going to go up much higher than the added cost of doing this.
Thanks, sir. Is there anybody else who would like to speak anyway to this bill, for or against? What, if you would come up and tell us what your name is and who you're with, and
Right here.
right there where.
I have been waiting for this moment for almost 4 years now.
So, Mr. Chairman, members of the committee, my name is Bobby Potter, and I'm here this afternoon on behalf of State Farm Insurance Company. Some weeks ago, Michael Shellnut had raised this issue with me and asked me for input on behalf of State Farm, and I sent that up the food chain, and I got some concerns expressed in that regard. When Representative Montahan brought this bill, he came to the hall and showed that to me and said, basically, He wanted to assure me this was not on behalf of the Georgia Trial Lawyers Association, and I appreciated that. But he explained what it was, and I would just say this: when I inquired of my folks, I posed to them. I'd assumed that you, State Farm, insure more unit owners than associations, and the answer was surprisingly, no, we insure both of them. But they expressed to me concerns about this because, as you have noted, the heart of the bill is the equitable allocation amongst unit owners could be 100% of the master policy of the association, as opposed to the $5,000 cap that's in place. So, notwithstanding all of what I've just learned about condominium law and associations, that seemed to be a concern to the folks I represented at State Farm, and they've expressed that. You all have expressed far more concerns than were expressed to me, but it's the similar concerns in regard to that equitable allocation.
Good. Thank you, sir. Anyone else? Let me say that from a country boy standpoint here, I hear you loud and clear. I've built homes and I know I can remember when we were building them for $45 a foot, and I know what they're building for now, and it's very expensive. And we hear what you're saying. This is a very complex issue, and we could make a terrible mistake here doing something quickly. The unintended consequences of what we do sometimes are much worse than the situation you find yourself in. And this is kind of water already under the dam. Y'all are deep into this thing, so we want to figure out a way what's best for the citizens of Georgia. And so we've got some good minds in this room, including yours and the other people and the members from all aspects. And I think we need to, this was a hearing only, and we've had some key people here, and I think we need to sit back and see what we need to do to fix this issue for the state of Georgia and get back with it. And now I'm not saying that will be next week or before crossover, but it could be. So it's something we need to look at. And we heard you loud and clear, and you are people of Georgia, and the people that live in those condos and own them are the associations are. So we're going to take a look at it, and it is a problem.
I will tell you that if we're looking for what's in the best interest of the citizens of Georgia, this change will help all of the owners within a community, all that are citizens of Georgia. It really, and by the way, we also have gone to the insurance agents who specialize in insurance in the community association industry, people who would get higher commissions with higher priced, and they're the ones who also want to see something like this done, because associations, their assessments are skyrocketing. I have not been to an annual meeting. I go to a lot of annual meetings for associations. I have not been to an annual meeting this year where the insurance premiums for associations was not discussed, and homeowners were told that the reason why their association assessments are going up, and they're going up like $20 or $30, whatever it is, they're not happy about that. If they get hit with a claim and then there's a big assessment, that's going to be worse than their assessments and the HO6 premium.
Thank you, sir. Representative Momahan, have you got anything you'd like to add?
Well, thank you, Mr. Chairman and members of the committee for hearing this bill out. And it looks like we've got some work to do. And I know this is a very good committee that does a lot of very good work. And I'm assured that we will get to the bottom of this issue so that Georgia citizens can be properly covered.
Thanks, sir. Does anyone else on the committee have anything like to add before we dismiss?
No, Mr. Chairman, thank you very much, and I thank these gentlemen for their patience in answering our questions.
Well, yeah, and I do. And very, very informative. And again, we know this is serious to us too. Thank you very much. Meeting adjourned.